The housing market just lost $2 trillion in a single night. Not over months, not across quarters, overnight. And if you're waiting for the news to explain what that means, you're already too late. Because what collapsed wasn't just home prices. It was the illusion that held the entire system together. The belief that real estate always goes up, the assumption that 30-year mortgages were safe, the quiet lie that American homeownership was still built on something real. That belief had just shattered. And the rubble is spreading faster than anyone is willing to admit. This isn't a correction. This is a liquidation. And it started the moment the market realized something every hedge fund already knew. The math stopped working 6 months ago. Let me show you what actually happened. Because the headlines will call it a crash. They'll blame interest rates or sentiment or some vague economic slowdown. But that's not what this is. What you just witnessed was a repricing event. A forced reconciliation between what homes were valued at on paper and what they're actually worth in a world where nobody can afford to buy them. $2 trillion didn't disappear. It was never real. It was a placeholder, a number sustained by liquidity, speculation, and the assumption that someone else would pay more tomorrow. And the moment that assumption broke, the entire valuation structure came apart. Here's the part they won't tell you. The housing market isn't just homes. It's a derivatives tower. It's mortgage-backed securities. It's collateral chains. It's pension funds in Ohio that own slices of California subdivisions. It's European banks holding American housing debt repackaged as AAA-rated instruments. When home prices fall, those instruments don't just lose value. They lose credibility. And credibility is the only thing holding up a $40 trillion mortgage market. So when $2 trillion evaporates overnight, it's not just wealth destruction. It's a credibility bomb. And the shockwave is already moving through the system. Let's go back 6 months. Because this didn't start last night. It started the day mortgage rates crossed 7% and refused to come down. At 7%, the average American can't afford the average American home. That's not opinion. That's math. Median income versus median home price versus borrowing cost. The equation doesn't close. And when an equation doesn't close, one of three things happens. Either incomes rise, prices fall, or the market freezes. Incomes didn't rise, so prices had to fall. But they didn't fall gradually. They held, artificially, stubbornly, suspended by sellers who refused to accept the new reality, and by a financial system that could not afford to mark those homes to market, until last night. What changed? Liquidity. The bid disappeared. Not because buyers lost interest, because buyers lost access. The mortgage market seized. Lenders tightened standards. Down payment requirements jumped. Debt-to-income ratios were slashed. And suddenly, the pool of eligible buyers shrank by 30% in a single policy shift. 30% fewer buyers means 30% less demand. And when demand collapses in a leveraged asset market, prices don't drift lower, they gap down. That's what you saw. A gap, a repricing, a violent adjustment from fantasy to reality. But here's where it gets worse. Because the $2 trillion that evaporated wasn't evenly distributed. It was concentrated. In the markets that ran the hardest. In the cities that believed their own hype. Austin, Boise, Phoenix, Miami, Las Vegas. These weren't just hot markets. They were speculative bubbles wrapped in migration narratives and remote work fantasies. And when the narrative broke, the speculative premium collapsed first. Homes that sold for $600,000 last year are listed at $450 today. And they're not selling. Because the bid isn't at $450. The bid is at $375. But sellers won't take $375. So the market just stops, frozen, waiting for capitulation. And capitulation is coming. Because the people who bought at the top aren't wealthy. They're leveraged. They bought with 5% down. They bought with adjustable rates. They bought because they believed the story. And now they're underwater. Not theoretically underwater. Actually, underwater. Their mortgage is bigger than the value of their home. And when you're underwater and your payment resets, you have two choices. Sell at a loss or walk away. Most will try to sell, but there's no one to sell to. Because the next buyer faces the same math. And the math says, wait. Wait for lower prices. Wait for forced sales. Wait for the foreclosures. That's the next phase. Foreclosures. Not today, not tomorrow. But 6 months from now when the payment shocks hit and the modification programs run out. Because here's what nobody wants to say out loud. Millions of homeowners are holding on by their fingernails. They're making payments they can't afford on homes they can't sell in a market that's already turned against them. And they're doing it because they believe it will get better. That rates will come down. That prices will recover. That this is temporary. But it's not temporary. It's structural. The affordability equation is broken. And it's not coming back. Let me show you why. Because this isn't about sentiment. It's about physics, the physics of debt. The average American home costs $400,000. At 7% interest over 30 years, that's a monthly payment of $2,600. Add insurance, add property tax, add maintenance. You're at $3,500 a month. To To qualify for that mortgage, you need an income of $10,000 a month. That's $120,000 a year. Median household income in America is $75,000. Do you see the problem? The average American cannot afford the average American home. And when affordability breaks, prices have to fall, or the market dies. Right now, the market is dying. Sales volume is collapsing, inventory is spiking, days on market are stretching, and price cuts are accelerating. But the headline number, the median sale price, is still holding. Why? Because the only people selling are the people who have to. And the only people buying are the people who can afford to wait for a deal. So the transactions that do happen are outliers. Either distressed sales that don't get reported or luxury sales that skew the average. The middle is gone. The middle is where the $2 trillion evaporated. In the homes that should be selling but aren't. In the equity that should exist but doesn't. In the wealth effect that was supposed to make everyone feel richer but is now making everyone feel trapped. And trapped is the right word. Because homeowners are stuck. They can't sell without taking a massive loss. They can't refinance because rates are higher now than when they bought. And they can't tap equity because the equity is gone. So they sit and wait and hope. While their balance sheets slowly implode, this is what a slow motion collapse looks like. It doesn't happen in a single day. It happens in 1,000 quiet failures spread across 18 months. A missed payment here, a strategic default there, a lender writing down a loan, a pension fund marking an asset to market, each one small, each one containable, until they're not. Because the system is interconnected, when home prices fall, property tax revenues fall. When property tax revenues fall, municipal budgets collapse. When municipal budgets collapse, services get cut. Schools, infrastructure, public safety. And when services get cut, the desirability of living in that area falls, which puts more pressure on home prices. It's a doom loop. And it's already spinning in the cities that were most dependent on real estate wealth. The cities that built their entire fiscal model on rising property values and transfer taxes and development fees, those cities are about to discover what happens when the money stops. But let's zoom out, because this isn't just about homeowners or cities, it's about the entire credit system. Mortgages are the foundation of modern finance. They're the safest, most stable, most predictable asset class in the world, or they were. When mortgages lose value, everything built on top of them loses value. Mortgage-backed securities, collateralized debt obligations, structured credit products. These aren't abstract financial instruments. They're the plumbing. They're what pension funds invest in, what insurance companies hold, what foreign central banks use as reserves. And when that plumbing cracks, the whole system leaks. That's what $2 trillion evaporating overnight means. It means the foundation just cracked, and the people who manage the system know it. They're not panicking yet, but they're preparing, quietly, behind closed doors. Stress tests are being run. Contingency plans are being dusted off. Margin calls are being monitored. Because the risk isn't that home prices fall. The risk is that home prices fall and trigger a wave of forced selling in credit markets. And forced selling in credit markets triggers a liquidity crisis. And a liquidity crisis triggers a broader financial panic. That's the real danger, not the housing market, the contagion. So what happens next? Because the collapse already happened. The $2 trillion is gone. The question now is whether it stays contained or spreads. And the answer depends on one thing: confidence. Do lenders still believe borrowers will pay? Do investors still believe mortgage-backed securities are safe? Do regulators still believe the banks are solvent? If the answer is yes, this stops here. If the answer is no, this accelerates. And right now, confidence is wobbling. Not breaking, but wobbling. Because the math is ugly, and the math doesn't care about narratives. Here's the math. Home prices need to fall another 20% to restore affordability. That's not a prediction. That's arithmetic. Incomes aren't rising fast enough. Rates aren't falling fast enough. So prices have to fall 20% from here, maybe more. And a 20% decline from current levels takes us below the 2019 baseline in most markets, below the pre-pandemic normal, which means every homeowner who bought since 2020 is underwater. Every refinance, every cash out, every HELOC, underwater. That's not a housing correction. That's a wealth wipeout. And the wipeout is already beginning. Because the smart money saw this coming, the hedge funds that bought 10,000 homes in 2021 are dumping inventory now. The institutional landlords that paid peak prices are marking assets down. The private equity firms that built entire portfolios on rising rents and rising values are quietly exiting. They're not waiting for the bottom. They're selling into the collapse because they know what's coming. Forced sales, margin calls, redemptions. And when forced selling starts, prices don't find a floor. They free fall until the leverage breaks. That's the part most people don't understand. Real estate isn't just an asset. It's a leveraged asset. Most owners only put down 10 or 20%. The rest is debt. And when prices fall faster than equity, the debt becomes unsecured. The collateral isn't worth the loan, and when collateral isn't worth the loan, lenders have a problem, a solvency problem. Not today, but soon. Because if home prices fall another 20%, a significant portion of the mortgage market goes underwater. And banks can't survive with underwater loan books, not at scale, so the banks have a choice. Take the losses now and recapitalize, or extend and pretend. Let borrowers miss payments, offer modifications, delay foreclosures, anything to avoid marking the loans to market. Because the moment they mark to market, the losses become real. And real losses mean capital requirements. And capital requirements mean dilution or bailouts. And bailouts mean political risk. So they'll delay as long as possible. But delay doesn't solve the problem. It just makes it bigger. And while they delay, the real economy suffers. Because when people feel poor, they spend less. And when they spend less, businesses earn less. And when businesses earn less, they hire less. It's the wealth effect in reverse. And it's already happening. Retail spending is softening. Consumer confidence is falling. Credit card debt is spiking. These aren't coincidences. These are symptoms. Symptoms of a population that just watched $2 trillion of wealth evaporate and realized they're next. But here's the part that should terrify you. The $2 trillion that disappeared? That's just the beginning. Because real estate is a slow-moving market. It takes time for distress to show up, time for sellers to capitulate, time for foreclosures to process, time for lenders to admit losses. The $2 trillion was the easy part, the obvious part, the liquid part. The real collapse happens over the next 12 months as the illiquid part reprices, as the homes that aren't selling finally get marked down, as the owners who are holding on finally give up, as the banks that are extending and pretending finally face reality. That's when the real losses emerge. And those losses won't be $2 trillion. They'll be 5, maybe 7, maybe more. Because the housing market isn't just homes, it's the entire consumer credit system. It's the largest store of wealth in America. It's the collateral behind trillions in loans. And when that collateral loses value, the whole structure wobbles, credit tightens, lending standards rise, access to capital shrinks. And when access to capital shrinks, economic activity slows. And when economic activity slows, the cycle accelerates. It's not a crash, it's a spiral. And the spiral just started. Now let me tell you what this means for you. Because this isn't abstract, this is personal. If you own a home, your net worth just took a hit. Maybe you don't see it yet, maybe your neighbor's house hasn't sold, maybe the Zillow estimate still looks okay. But the market has already moved. The $2 trillion evaporated because the bids disappeared. And when the bids disappear, the price is whatever the last desperate seller accepts. That's the new comp, that's the new baseline, and it's lower than you think. If you were planning to sell, you're now in a race against time, against inventory, against forced sales. Because every month that passes, more homes hit the market, more sellers capitulate, more prices drop. And the longer you wait, the worse the comp gets. But if you sell now, you lock in a loss. So you're stuck between selling at a loss or holding and hoping. And hope isn't a strategy. If you were planning to buy, you're now in a different race, a race against fear. Because everyone is telling you to wait. Wait for lower prices. Wait for the bottom. Wait for the opportunity. And they're right. Prices are falling. But the bottom isn't a moment. It's a process. And by the time you're sure it's the bottom, it's already over. The real opportunity is now, in the chaos, in the fear. When sellers are desperate and buyers are paralyzed, that's when fortunes are made. Not at the bottom, in the collapse. But most people won't act. They'll freeze. They'll watch. They'll wait for permission from the media or the Fed or some external authority. And by the time permission comes, the opportunity is gone. That's how every cycle works. The early movers win. The late movers lose. And the people who wait for certainty get neither opportunity nor safety. They just get stuck in the middle, watching their wealth erode while the system resets around them. And the system is resetting. Make no mistake. The housing market that existed 6 months ago is gone. The market where homes always went up, where leverage was free, where speculation was rewarded, that market is dead. What comes next is different. Smaller, slower, more rational, less forgiving. And the people who thrived in the old market will struggle in the new one. Because the new market punishes optimism. It rewards patience and math and the ability to wait while everyone else panics. So here's where we are. The housing market just collapsed. $2 trillion evaporated overnight. And the collapse isn't stopping. It's accelerating. Because the math was always broken. The affordability equation never closed. And now the market is forcing the reconciliation. Prices are falling. Equity is vanishing. Lenders are tightening. And the contagion is spreading. Not into the headlines yet, but into the credit markets, into the pension funds, into the balance sheets of institutions that thought real estate was safe. This wasn't a surprise. It was inevitable. The moment mortgage rates crossed 7% and incomes didn't rise, the housing market was doomed. The only question was timing. And last night, the timing arrived. The bid disappeared, the repricing began, and $2 trillion of imaginary wealth was finally recognized for what it always was, a placeholder, a promise, a bet that someone else would pay more. And that bet just lost. The institutions will respond, but they'll respond too late, because they always do. They'll cut rates after the damage is done. They'll offer programs after the foreclosures hit. They'll stabilize the market after the wealth is gone. That's not cynicism. That's history. And history is repeating right now, in real time. In your neighborhood, in your equity, in your net worth. The math is already locked in. Physics doesn't negotiate. The housing market didn't just collapse, it repriced. And repricing is just another word for truth. The truth that homes were overvalued, that buyers were overleveraged, that the system was built on assumptions that no longer hold. And now the truth is out. The illusion is shattered. And $2 trillion of wealth just learned it was never real. This was always unavoidable. Now I want to hear from you. Knowing what you know now, knowing that $2 trillion just evaporated, and the repricing has only just begun, would you buy a home today, or would you wait? Drop your answer in the comments. Are you buying into the collapse, or are you waiting for the bottom? Let me know. And if this video gave you clarity while everyone else is still confused, hit that subscribe button. Because the market is moving faster than the headlines, and you need to stay ahead of it. I'll see you in the next one.